Hello, everyone, and welcome. I am super excited that you're here for a very dynamic and honest conversation about two very different but equally powerful paths to build a brand in the health and wellness space. And today, as you know, we are talking about venture capital, but we decided to extend it a little bit and not just talk about venture capital, but also talk about bootstrapping. And some companies have raised millions of dollars and others haven't, but are still growing and are thriving. And both ways are valid and both ways are equally hard. And both ways to build a company require vision, grit, and serious strategy. And I'm very lucky to have two incredible leaders with me today who embody these two paths. And first, we have Alisa Vitti. Alisa is a pioneering force in women's health. She's a functional nutritionist, hormone expert, and best-selling author. She wrote the books Women Code and In the Flow, and you can see some of her books in the background. And Alisa created FLO Living in 2001, which makes the company one of the first femtech companies dedicated to revolutionizing hormone care. And she's self-funded and is the creator of the cycle syncing method, which is a groundbreaking approach that aligns nutrition, fitness, and lifestyle choices with the phases of the menstrual cycle to optimize female health and wellness. And Alisa is here to share how she scaled her brand without venture capital. And joining her is Carolyn Simmons, a seasoned venture capitalist with deep expertise and experience in the CPG world. And her most recent role was a partner at Mellitus Ventures, a venture capital firm that invests in early stage consumer companies. Carolyn also served as a VP at Alliance Consumer Growth. She was partner at Circle Up, a data-driven growth equity firm specializing in emerging CPG brands, worked in private equity, where she evaluated acquisitions of larger consumer and retail companies, and was in investment banking in the consumer retail group at Goldman Sachs. And in case you don't know who I am, my name is Susanne Mitschke, and I am the co-founder and CEO of Citruslabs, the leading contract research organization for decentralized clinical studies for consumer brands. And I'm sure that you are having a lot of questions at the end, so please make sure to put them into the Q&A field of Zoom. And I would say we get started. Alisa and Carolyn, welcome. Thank you so much for spending time with us today and sharing your wisdom and knowledge. And let's start with Alisa. What inspired you to actually start FLO Living?
Well, it was obviously my own firsthand experience as a patient of having hormone problems and really seeing firsthand what the model of care limitations really kind of created as an impact on, my personal journey to try to get hormonally healthy. I saw that there was sort of a one size pill fits all approach to dealing with hormone issues like the ones that I had, which were PCOS. I went undiagnosed for a decade. And it was really frustrating. I was covered face, chest, and back in cystic acne. I didn't menstruate from the age of 12 to 22. I'm 5'6". I was 210 pounds. I was insomniacal, anxious, depressed. For anyone who maybe is listening that's going through menopause, when you have your hormones sort of in chaos, it also throws your life into total chaos. And that was very heavy as a teenager and was very eye-opening to be confronted with the reality that doctors literally didn't know what was wrong and what to do. So it began the journey of, well, how do I get better? And since I realized I was one of millions of women who were suffering not only with PCOS, but all sorts of other hormonal issues like fibroids or endometriosis or things where they just don't have an understanding yet of what is, what needs to be done for these things. I thought, what can I do, to put my own oxygen mask on and take care of myself. But then if I could figure that out from, let's say, a clinical perspective, how can I build a platform that would serve all these other women? Because the experience of going through not knowing, the frustration, the gaslighting, the fear around what's going to happen to me long term was just unacceptable. And this was 25 years ago. We're not much better today. It's a little bit better, but not much. And so FLO Living was born out of a personal experience where I just thought there can be a much better patient journey to dealing with these castaway GYN conditions. And that's what we do. We treat women from their first bleed to their last with the natural food-based macro and micronutrient protocols that I've evolved over the years.
And we will go into that and also into the research you're planning and conducting a little bit later. But let's quickly go to Carolyn. Carolyn, did you always want to be a venture capitalist?
No, it was not a childhood dream. It is how life unfolded. I started with, I guess, being a consumer of products, and really being fascinated by the motivation behind purchase decisions, um, how to build a good business, and how trends bubble up, evolve, and grow. I started my career really at the latest stage of consumer investing and advising strategics that buy these businesses, and slowly moved earlier and earlier, where in venture capital, I have my ear to the ground on what are the latest emerging trends that we see really being structural trends down the line.
And in your opinion, what makes a CPG company attractive to an investor?
Oh, that's a great question. I like to say that it's both an art and a science. And different people will have different opinions on this. But in my mind, a few things rise to the top, which is one, I look for great teams of people, great founders that are willing to move mountains to get things done, that have real strategic vision, and an idea for building not maybe just a single product, but a platform form of products, or services. So team is definitely one. And then what is the product or service itself, and how is it differentiated or novel? How does it compare to others in its competitive set? Why is it solving a pain point? And I look at a lot of businesses that maybe aren't catering to a specific need or pain point. I really look for what's wrong right now with the purchase, the decision, the offering, and how can it be improved. Um, and then I look for signs of momentum. And I define that broadly as, that can be as straightforward as top line sales, or it can be as ambiguous as, things like social following or engagement on social platforms. Um, and then being a venture capitalist too, I think about, how are we going to exit this business? Who's the universe of buyers? What are they looking for? How much would they pay? And backing into whether that makes sense from a risk reward perspective is what I do.
Okay, that's great. So you're looking at team, you are looking at products, how it's differentiated, how novel it
Differentiation.
is. Why is it a pain point, and probably also why should we solve it now? Um, and then you're looking at momentum, and you're also thinking already about how to exit this business. And
That's right.
Alisa, when you started FLO Living, and even when I started my first company, MindMate, the startup market and also the venture capital market looked very, very different. In in 2015, and Carolyn, correct me if I'm wrong, but like a 5 million in funding was like a Series A. And today we are seeing like 10, 15, 20 million as Series A. And I have the feeling that founders feel a lot of pressure to raise venture capital. And what made you decide, Alisa, to bootstrap FLO Living? Because when I'm looking at what Carolyn just mentioned, what she's looking at, right? You're checking like all of these boxes.
Yes, it's been an interesting journey. So before I founded FLO Living, which was actually in 2012, not 2001,
Oh, sorry.
it's okay. I had a clinical practice in Manhattan where I was seeing patients one-on-one and refining my protocols. And I did that for about a decade. But what I learned in that process was that one-to-one model was really limiting for what I had as my sort of big picture goal, which was to really help as many women as possible and not be geographically limited. And I was also growing, by word of mouth. And so we were already struggling with issues about how do we handle sessions with different time zones and geographies. And so in 2010, I started thinking to myself, and again, this is 2010, the words telehealth, femtech, and functional medicine did not exist. So I started asking, well, how could I use technology to scale out of a one-to-one model into a one-to-many model? And I started figuring out how I could build a little platform to do that. There were no plug-and-play SaaS tools, so I actually custom built our own platform to disseminate the protocols from a one-to-one model to a one-to-many. And I did try to fundraise, but you have to imagine back in 2011, there was no understanding of what I was trying to do. I've been such a first mover and so far out for such a long time, and like the timing for fundraising was not on my side. So I remember sitting down with a gentleman who ran a very successful like media company who was investing in more, I don't even know if wellness is the right word, but it was advised that I sit down with him, and I shared the deck, talking about hormones and periods, and within like the first 5 minutes, he starts talking about his erectile dysfunction, and I got really like uncomfortable. And it was like conversations like this where I just thought, okay, there was some of that, and I was like, okay, I need to leave the room. And then there was just also no one was looking at the space. So though I tried, it just didn't come together. And so I was left with the choice of, well, do I pack it in, or do I figure out how to, from the beginning, run a profitable and cash flow positive business? And how do I do that in a way that also allows me to scale? So from the beginning, I had to be extremely disciplined and judicious about the choices that I made around product development, customer acquisition, team growth, marketing, all to stay within budget and all to, keep an eye on profitability so that the cash flow is king if you're not funded. Mm-hmm. And ironically, now on the other side of this, I talk to so many founders and investors who are like, the fact that you've done that for the past 12, 13 years is unheard of. And, we're only interested in companies today who have some signs of profitability and cash flow, mm-hmm. Management. So it's been a very bumpy ride. I certainly over the years have felt FOMO around the funding experience, but, I keep coming back to the fact that we're growing and we do what we need to do with the capital that we have. And that there's probably a lot of value in all the learning from a leadership perspective that I've gleaned in running a really tight ship and doing a lot with limited resources and being extremely creative with that. So yeah, certainly have learned the long range truism that constraints breed creativity for sure.
That's great. That's a fantastic story. And I also feel that the venture capital market is changing a little bit. Even like before 2020, right? You could just, be unprofitable, but as long as top line revenue was good, everything was perfect, right? But now we are seeing like that shift that investors are looking for companies that are already profitable or are on the way of profitability. And Carolyn, in your opinion, like how did the venture capital market change? Especially, I think there was a big change happening in the last like 2, 3 years, even.
Yes, and you'll see those swings in bull markets where you've got investors are throwing money at companies. When we look at businesses or what, really we're looking at, in addition to momentum, the business model and capital efficiency and how much really the company is going to need to raise potentially until exit. Yes, in answer to your question, there has been a shift and really having taken place over the last few years where there's much more of a balance I've seen of not just top line, but also bottom line, which can vary by industry, right? If you're in a high margin business, like a skincare or a supplement category, you'd expect much higher margins than, say, a big beverage business, for example, where you bake into the fact that it's going to be more capital intensive. The business is going to need to raise more. Um, uh, yeah. Any other follow-up questions on that? Otherwise, I think inevitably it will shift as well, depending on the market climate. But that's where we're in right now.
And is there a situation you would actually recommend a founder should opt for bootstrapping over raising venture capital? Because I'm seeing a lot on LinkedIn, right? A lot of VCs, recommending that, hey, not everyone needs to raise VC. You should bootstrap. So what is your um, opinion and kind of thoughts on that whole topic?
Um, I really think that it starts with an open and honest conversation with an alignment between the VC firm and the founder about what the end goal is, because and making sure there's alignment there. So the VC is going to put money into a business, acquire a stake, typically a minority stake of a business, with the end goal of exiting in typically 5 to 7 years. That creates pressure on the system. And the benefit of that capital is that with the right strategy and luck and perseverance, you'll grow that business potentially more quickly than you would without raising outside capital, at the cost of a percentage stake of the business. Without that capital, you do not have the external pressure, and maybe you do not want to exit. And so where I often see trouble arise is, you know, maybe there's a founder that is happy running his or her business, and then in that case, I wouldn't say it's needed to raise a bunch of venture capital money because that won't work in the end, when VC is ultimately looking to exit and make money off of their investment.
Yeah, I think that a lot of founders also think wrong about venture capital. They think it's kind of, starting capital and then they can do whatever they want with it, right? Versus once you raise VC, you have to actually go down that route, right? You go from maybe a pre-seed to a seed to a Series A to a Series B, if needed, a Series C until there's an exit or an IPO, obviously, right? Which is also an exit.
No, beyond just the capital, there are controls and potentially a board seat or a
Mhm.
board that's created. And you're not just on your own running your business. You've really got to be sure that you feel good about having another voice at the table with real governance rights. So that it's a great point.
And one thing that Alisa is doing right now, even without venture capital, is she's investing a lot in research. And Alisa, can you tell us a little bit more about what you're doing with your upcoming study or even studies, and why you're doing that, and what you're hoping to get out of the whole research you're conducting?
Well, I think, again, because I have spent so much of my career, or all of my career, working around the systems of constraints, one of the things that's a constraint right now in the world of women's health is the lack of adequate research on our hormonal issues. And, last year, probably around Q3, I just decided, by whatever means necessary, I would like to do my part to contribute to closing the gender gap in that research. And, you know, really was so excited to figure out a model that was so direct, right? Meaning we didn't need to seek out outside funding or government grants. We sort of kind of came up with this sort of consortium collaborative model where partnering with a couple of different other femtech companies and partnering with Citruslabs to help us, really kick off a study on the methodology that I created, the cycle syncing method. So we're really excited about that. And I think it's historic for so many reasons. One, because it's the first official cycle syncing study, but also because it's this model of conducting research in a way that is not limited or relegated or contingent upon outside funding / government grants. And I think from a femtech and women's health space, I hope that it sparks a lot of inspiration for other brands to do more of their own research to contribute to the closing the gender gap, because of the sheer amount now of companies that exist trying to solve women's health issues. There's just unprecedented opportunities for companies to collaborate and just create direct types of research that again are not contingent upon outside support. And that's really exciting. I think that's the most exciting thing about what's happening now. Again, I've been in this industry for over 25 years. What's happened in the past 5 years in terms of the femtech revolution is historic from a feminist point of view and a consumer point of view. And I think that we're just at the nascency of what that will yield. And I think we can be the change that we wish to see just by getting creative and working together.
Yeah, I think that was really a good thing that came out of COVID, right? Because we all had time, to think, we all had time to think about what's currently wrong, especially in the field of women's health. And yeah, lots of stuff has happened in the past 5 years. And Carolyn, based on that, what Alisa just said, right? There are lots of brands out there, and you mentioned that differentiation is a big thing for you when you are evaluating a brand. How do you evaluate a brand when they have a clinical study in their back pocket? You know, is that a plus? Is that a must-have? Is that something that you're actually interested in when you're looking at a company?
Um, it's a great question. I think what I'm looking for is signs of customer loyalty, more so than analyzing clinical trials. And there are some brands out there that have gotten pretty far without those clinical trials, but I would argue that to really be successful, differentiated brand that is sought after by an acquirer, you'd really want some research backing up uh, key claims. And companies that don't do that also get in trouble. So, but I'd say from the investor, wearing the investor hat, what you're looking for is, are customers buying this product? Are they being retained? How frequently are they buying it? Why are they buying it? And often the reason for that is because they are research backed and proven to be effective. So that's what I'm looking for. And I'm analyzing different retention and repeat rates across particular categories, diving into the comp set and how it compares across kind of markets.
Do you see that that there was a shift happening in the past couple of years where consumers get more savvy and consumers are looking for this research backing in particular? Because a lot of our customers are increasingly asking to get their studies published in journals and on ct.gov so that consumers can actually read about the study, because oftentimes they just have, this science sub page or, on the product, a little, title. And this was our clinical study. This is, how many people were enrolled, and these were the claims. But what we found is that a lot of consumers are asking to read more about studies. Did you see that as well?
I'm seeing consumers becoming more and more savvy with reading ingredients, reading, nutrition labels, um, more discerning, and more educated, with information at their fingertips, online and on different platforms. There was an explosion of the D2C channel in terms of
Mhm.
growth that really propelled a lot of purchase in that channel, but also just education. And what I'm seeing is, in addition to that, uh, a ton of new entrants. I mean, it is so competitive out there for brands because consumers are being inundated with options. And so anything like, not just clinical trials, but it's a combination of a lot of things that gives that brand that secret sauce and differentiation, I think is really important. And yes, in answer to your question, customers are leaning into clinical trials. But there's a lack of ability to really understand everything because there's so many brands out there. So a lot of different factors, but clinical trials being one of them for sure.
And Alisa, you've built a very loyal customer base, and you created something that, wasn't known to the consumer. That's like an entirely new concept to consumers. So how did you do that? How did you educate your consumers on why they should do cycle syncing? And how did you get the word out of this entirely new method?
Well, even before cycle syncing, the first iteration of the platform was really just about how do you address hormone imbalances between GYN visits, right? So how do you deal with your PCOS? How do you resolve PMS? How do you deal with fibroids? What is the non-pharmaceutical approach to dealing with this in a most effective way? And yeah, that was a completely new concept. That's really what the first book was about that came out of my clinical practice, and those protocols. And what we did, really, we called it our education to conversion model, where we spent a lot of time, you know, writing blogs. At the time, Facebook Lives were a channel where I would educate weekly on different topics. That's evolved over the years, and there's some new things coming down the pipeline this year for the brand. But it's really, I've always believed that what women desperately need is a very direct, very intense education on their hormones. Nothing watered down, nothing dumbed down, just the facts. And they really loved that and found it to be so reassuring, like I did as a patient number zero, right? Like, and as I say to our consumers, there's the overwhelm and the frustration of being stuck in your symptom set, and there's the fear of not knowing what to do. But when we walk over the bridge of scientific information and facts, we can feel confident, at least, that we're moving in the right direction, even if we're unsure of how the outcome is going to be achieved, right? And that's the thing that I think we've always done really well as a brand, is putting that science forward. I think the other thing that's unique about the brand is that you have me as not just the founder and CEO, but also as a researcher, an author, a speaker, and a thought leader in the women's health space. So I'm not just communicating through the brand, but I'm also out in every media outlet and podcast, and I have done for so many years, shifting the cultural narrative about what it is that we need to know about our hormones on platforms like Mind Body Green and Vogue and the New York Times and whatever, just, really advocating for what women should be thinking about and considering when it comes to managing their hormones. And I think the greatest gift when you're doing something new and truly novel in a space, which is certainly the case for our brand and has been for a while, is time. Time is a valuable currency because it takes time to educate the consumer. It takes time to build the trust with your consumer base, to earn that reputation, to maintain that reputation, and to build on it. And so, to Carolyn's point about funding or not funding, I think in a way it was excellent at the time, 13 years ago, that we didn't raise venture, because we've had the gift of time to evolve this conversation and to co-evolve products with our consumer. I mean, I'm an unusual founder because I never planned to be an entrepreneur. The plan was always to be a practitioner, but because there was always this product need tension that I was made aware of in working with my patients, I felt obliged to build the thing that they were asking for. And that's what we have done also over time. At first they needed a time zone and geography free way to access the protocols. Then they wanted an app. Then they wanted supplements at the therapeutic doses that I was recommending to them. So we started formulating ourselves. So we've built this over time, and that's why our product market fit has always matched our consumer need, and their education matches, it all works out with timing. And it's been really fun to kind of learn with them over this period of time.
That's fantastic. And I think that's also a big difference to like a classic venture capital model, right? Where you have like this time horizon versus you, Alisa, you're doing it as you grow, right? And as you learn and doing it step by step versus venture capital, you have to do everything all at once. So that you are reaching an exit. And also because the ultimate goal of the venture capital model that I think many people are forgetting is that once you raise venture capital, it is your responsibility to create shareholder value, right? And create essentially a good outcome for your investors, and not only for you or for your consumers, for your customers, right? I think this is one thing that many people are forgetting when they're going down the venture capital route. But that has been great. I would like to also take some time for questions. So we have Ben here as well, our marketing manager, Citruslabs, and he will help us navigate any questions. So now is the time for our audience to put questions into the Q&A field. And we're just waiting for the first ones. I think one question that I still wanted to ask Carolyn is what do you think are like common pitfalls that founders tap into?
Let's see, common pitfalls. I think that potentially due to external pressure, I see founders extending too quickly, both in terms of product and channel, um, uh, before making sure that and validating that the product is selling, the channel is working. So for example, rather than launching into retail, D2C, B2B, and offering several different products in several different categories, testing and learning while balancing still top line growth is really important. Um, uh, I see this a lot in retail. You've got one shot to sell your product on the shelf, and if you don't succeed, the retailer will kick you off the shelf. So making sure it's selling well and the economics are working is important before overextension. And that's one example that I've seen a lot of recently. Um, in terms of the fundraising itself, I would say that it's important to get to know investors early. And I see an issue a lot of times of founders wait until late in the game to get to know investors, and it's a more difficult time-strapped conversation when they've got a month left of cash runway. And the companies that are really successful in fundraising have started conversations early, not necessarily formally pitching their business with a pitch deck and formal process, but have relationships with several different funds who are familiar with their business. And it's more of a natural fit when timing works and it is, really they need to raise or they want to raise. And it's also a good personal fit too. You want to like who you're working with because they're your partner for the life of your business. Those are just a few. I could go on.
I think I could add some thoughts from the bootstrap perspective of things I see other founders that I advise doing, some common pitfalls, which is similar to your first thought, just kind of spinning too many plates at once. There's sort of a mindset that everything is important in business, right? And an example that I often give when I am advising other founders is a real life example from my own brand is we built one website back in 2012. We probably updated it a little bit here and there, but we did not do a full rebrand until the 10-year anniversary. I refused to spend money on that because I had to make a choice about where to invest that capital as a bootstrapper, right? And so, yes, one could make the argument that it's important to make sure that the visuals are where they need to be, as well as, developing your app, as well as formulating products and managing inventory. But you can only do one thing at a time when you have cash constraints. Not only that, but you also need to be focusing your team on projects. And I think a book that I really love recommending to founders, whether you're bootstrapped or venture backed, is Essentialism, because the whole concept is, and I love the visual that's probably in the first chapter of the book. There's a circle with a lot of little arrows sticking out of it, and that's you as a founder, vibrating in every direction but going nowhere fast, versus you as in the circle with one arrow pointing out, where you're just focused on getting one thing done. So we've adopted it with my team at FLO Living, and we've done this for years, which is we're going to focus on launching or building or doing one thing per quarter as a team. And we're only focused on executing that and bringing that to completion. And it really makes for satisfying culture and project management, because we just are all in on that one thing. We get it done with, a lot of success and vigor. We're all energized around it, and we can celebrate our accomplishment distinctly and crisply, and we can own that at the end of every quarter. Whereas prior to figuring this out, I was also trying to spin too many plates at once, and we were getting nowhere fast. So that, I think, is the biggest pitfall, because there are real cash implications to trying to do too many things at once, and you can quickly put yourself out of business by doing that. So as a founder and a CEO, you have to take enough time in the due diligence around what is going to move the needle for your brand, for your business. Spend enough time doing that before you decide what you're going to rush into doing. And if you spend more time thinking strategically before you put your project map into place, you'll end up in a much better place without jumping into that trap of running out of cash because you did too many things at once.
Well, amen to that. That's very well said. I couldn't agree more with that statement. Also, I think when you're bootstrapped, it's less likely that you're just spending money on stupid stuff, because you really have to think about where to spend.
And, as a female hormone biohacking pioneer, I also think bootstrapping and running your business as a female founder, and I'm sure there are many other types of founders on the call, but it's so important to do it in a way that is sustainable to your health and well-being, right? So founder burnout is a real thing. Some of that comes from trying to do too many things at once, but especially for women, making sure that you keep your stress levels reasonable, and take on project scopes that are humane, because I see it on the practice side of things. So many female founders are dealing with early stage infertility, early stage perimenopause, simply because they've put their endocrine system through the grinder of overcommitting and having too much stress. And I think that in addition to seeing some new pathways for research, I'd love to see some new models for how we conduct business as female founders, with or without venture capital, that is more inclusive of our female biological needs, because I'd like to see more women building businesses in a sustainable way from a physiological perspective, so that they can, when they would like, have children and go through their 40s without, melting into a puddle of hot flashes and night sweats, which more and more women are doing. So, and I'm here as a testament to that, having been completely self-employed for my entire life, and about to turn 48 and not having any symptoms. There's a way to navigate your career and integrate management style and leadership such that you don't damage your hormones in the process. And I think there should be more conversation in the venture space for female founders to have some space to take up, to say, yes, we want to be on the clock to get to an exit, but we want to do that in a way that's sustainable for everybody, especially the female founder.
That's great. And that probably also will contribute a little bit to female founders getting more venture capital, But that's like an entirely different story, and we could probably do an entire webinar just on that alone. And to answer a couple more questions, for Carolyn, Amazon is big in CPG, and one person asked if one person essentially um, made like wrote us here that they are seeing a number of D2C brands that are not launching on Amazon right now. Is there a reason why that happens?
Um, if the question is more, so there's an observation that brands are not launching as much on Amazon.
Yes, that's
Um,
correct.
I don't know. I have not seen that. I know for sure that Amazon can be difficult to work with. And I know that going through that channel often eats at your margins, the margins of your business. So it can be expensive. So maybe that's why brands are moving more D2C. The other reason I can think of that's, could be another reason is that Amazon controls a lot of data on the customer, and being protective over that data. And maybe that's why they're seeing some reversion to D2C. But generally speaking, I'm seeing a lot of brands launching on Amazon. And the reason for that is that it is the powerhouse channel for
Hmm.
consumers when it comes to ease of uh, purchase and delivery. It's not necessarily a great channel for brand discovery. It's difficult to navigate, but it's a big growing channel, and so yeah, I think I'm seeing retail. I'm seeing a big reversion to retail actually, and maybe that's
Absolutely.
part of this question is that generally uh, it's becoming so expensive to sell online, and the cost of customer acquisition has gone through the roof in recent years that I'm seeing a lot of brands moving back to in person, in real
Hmm.
life selling on the shelves.
Yeah. Yeah, that's very interesting. Also, obviously in LA, right, we have Iruan, we have
Yeah.
lots of Whole Foods, and I think a whole Iruan is one big supplement
Erewhon is, yeah, the
distributor.
genesis of a lot of trends. Yes.
Yes, absolutely. And the next question is for both of you. Do you recommend working in corporate before starting a company, for example, 1 year at BCG? Alisa would probably say no to that question.
Oh, I have no opinion. I think it depends on, well, I guess I do have an opinion. I think it depends on what you want to focus your training on, so I think working in firms like that can be really valuable if you see your future, really in management and strategy. But if you are an entrepreneur sort of by nature, meaning you're looking around at problems and figuring out how you can solve them, you don't necessarily need to start that route. You can simply start thinking about how you would go about solving that problem. You can take other courses on, putting business plans together. I mean, you can really, especially in today's decentralized educational kind of environment, you can really get a lot of information and education and knowledge to help you figure out how to go about putting your business together. But if you don't have a clear idea of what problem you want to solve and you want to learn the art of running a business, managing teams, scaling, then I think being at firms like BCG are really give you that kind of overview by working in different companies as a strategic advisor, you'd get to see kind of behind the scenes, behind the curtain, and you'd learn kind of how the sausage is made, if you will, and then you could figure out what sausage you'd like to make. That's one way to go about it.
I think that was really well put, and I completely agree with you, Alisa. I think that, if you have a vision and idea and are really compelled to just jump right in and tackle it, then do it. I don't know that having a year at BCG is going to help, educate you and prevent you from making mistakes that you wouldn't otherwise just make, and learn from as you do it. If you are still contemplating what category or, what exactly you want to be doing, then maybe having some formal training in consulting or banking might help.
Ben, there's so many questions still.
And now we have a lot.
How are we prioritizing them? Because we have 5 more minutes.
Yeah, let's get so maybe just kind of a good one here, throwing it back to Carolyn. What are some of the, when we talk about VCs and exit opportunities, what are some of the trends that you're seeing with either like supplement or CPG brands that are getting to that point of exiting? Because obviously, that's kind of the main point of going the VC route.
Overall trends, I'll speak at a high level. We're seeing many acquisitions. We're seeing strategics continuing to fail to innovate in-house and thus turning to startup brands to acquire them. That's not necessarily a given. So, and I think that's a structural trend. Uh, in the space of supplements specifically, there are a number of supplement brands that have grown to significant scale that have failed to be acquired, however, and some investors are scratching their heads about that, including myself. Brands like Athletic Greens and others. And so it comes back to the original thesis that, Susanne and Ben, you have around Citruslabs, I think, which is how do you really differentiate yourself? And how do you, leverage real research and studies to build this kind of proprietary product in a way that can't be so those are some macro trends. Yeah.
Oh, that's great. Yeah, thank you. And maybe just one, kind of high level overview for you, Carolyn. When, how does someone get started with funding? Fundraising, like what are some of the first steps they can take? There's a lot of questions in here about, it can be super overwhelming, or how do I get the best introductions? Where do I kind of start? So maybe just touch on like how you kind of, start that process, how you, take the leap and, keep going at it. Because I know it's a long time consuming and, a high rejection process. So.
Yeah, I think a big piece of it is timing. And I wouldn't say that going direct to institutional investors when you're just starting to launch your business is necessarily the best route to take. I think it often starts with just relationships you have and getting the word out that you're looking to raise some capital. And that could be in the form of what's called an angel round. So pre-institutional raise. This is like a friends and family round, or maybe some strategic advisors that can put some personal money in. I think that going out of the gates, banging down the doors of big investment funds isn't necessarily the best approach. And raising a smaller amount of capital to kind of get things going and prove out some key milestones that then you can use and kind of arm yourself with to then go to institutional makes a lot of sense. And at that point, you're going to want to put together um, a small kind of overview presentation that includes what those things are and what your business does and who your team is. And you can use that to raise a more formal round. But I think it just starts with, you know, talking to as many people as you can. And oftentimes I hear from founders, you know, my most amazing, helpful, strategic and advisor investor turned out to be someone who I bumped into in the elevator who, you know, asked me about my product and loves my product. So there's no formal path. It's just about getting the word out and being really persistent.
Yeah, I think persistent is definitely the word for any founder. Alisa has been still is super persistent, right? I'm super persistent. I think every founder is super persistent, and if you're not persistent, you're losing. And you definitely do not want to lose, either if you are venture backed or if you're bootstrapped. And I think we had time. Thank you so much, everyone, for joining. And thank you so much to our amazing panelists, Carolyn and Alisa. Thank you for your excellent insights. And I hope that this was also useful to our audience. Yeah, I apologize we couldn't get to many questions, but we tried to answer a couple of them one to one. Yeah, thank you so much again for joining, and I hope you have a wonderful rest of your days.
Thank you.
Thank
Bye.
you.
Thank you
Bye.
guys. Bye bye.